Here's what's coming up on The Retirement Architect with David Reyes, your retirement television.
During 2008 was the worst time when clients came to me, not my clients, new clients, crying on my table because they had to go back to work or they lost their house, half their 401k. So the reality is we don't even need to be in that side of the equation. There's ways that we can do planning to where we can reduce risk, increase cash flow, and make sure we don't run out of money in retirement.
There's a direct correlation when interest rates go up, but bonds go down, correct?
It's math. I mean, you think about it. So let's say you have a bond, it's 1%, right? And you have a bond fund, which we talk about, and rates go to 2%, right? A 10-year bond, that's a loss of 10%. We want to make sure, is there things that we can do not only to reduce the taxes today for our income, but also if we have a large enough estate, what are some ways that we can reduce taxes when we both pass?
I know what a stress test is when I go in to see the doctor,
Sure.
right? Is it the same thing for my portfolio?
Pretty much,
Yeah.
right? Are you having a heart attack or not, right? We
Right,
don't want to have a heart
right.
attack in a portfolio. So yeah, it's the same concept is we're stress testing. That's why that word's used. And what does that actually mean? We're stress testing the portfolio against market events, bad market events like 2000, 2008, COVID.
You're watching The Retirement Architect with David Reyes, San Diego's retirement television.
Hi, San Diego, and welcome to this week's show.
Stay tuned. We have 30 minutes of great information just for you.
Don't go anywhere. The show starts right now. Hi, and welcome to this week's Ask the Architect, where you email your questions into us from all over San Diego, and we answer them right here on the show. David, I have some wonderful questions this week, and I'm going to begin with Andrew from Oceanside, and he writes, David, my wife and I both just turned 70, and we've gotten more and more worried about losing money lately. We have a national brokerage firm managing our assets of approximately $4 million. We told our broker we were so worried we couldn't sleep at night, and he modified our portfolio from 80% stock and 20% bonds to 30% stock and 70% bonds. Is this good?
Well, thanks for the question, but no. Unfortunately, right now, bonds actually are losing more money than stocks today. So that's a problem. And the real issue is that if you're concerned about cash flow, is that a portfolio like that of even half stock, half bonds is going to produce income of around 1.5%. So, most people need around 4 or 5% distribution for their portfolios. So you've just kind of switched one risk for the other, and you've actually decreased the future value of that particular investment. So if you have kids that you want to inherit money, those types of things, you've really done yourself a disservice. So, I would say that was it's kind of taking a blunt object and kind of beating your portfolio over the head, so to speak, is that there wasn't a lot of care with that. There's other things that could be done or can be done, which is great, to help to improve maybe the cash flow, reduce the risk as well, that can be a little more subtle, but maybe have more impact.
David, we get a lot of questions like this in this vein, which seems to be sort of an antiquated philosophy with all the different asset classes there are today. To just say that a portfolio should be stocks and bonds is maybe not, and correct me if I'm wrong, taking advantage of all the wonderful modern philosophies, products, services that are out there today. Fair statement?
Absolutely. I mean, the fact is you can add real estate to your investments. We use that. You can use some principal protected investments. You could add some other things instead of those bonds, replace some of those bonds with maybe some real estate assets, maybe some other principal guaranteed investments that can do the same thing, but also give you, or better, but give you more cash flow, give you more diversification. I call it diversification. Diversification is I own 50 stocks instead of 10 stocks. I own 1,000 stocks. Doesn't matter if the stock market goes down, you're going to go down. So we want to diversify different asset classes above stocks and bonds.
Gotcha. My next question is from Mandy in Point Loma, and she writes, you always talk about how much risk someone has and that you can reduce that risk. Well, we both just retired and have $2 million in assets, and we don't want to lose much of it. We like the idea of 5 to 10% risk, but what if we want 0% risk in our plan? Can you do that? Are we just being dumb and scared, or are there other people that feel the way we do?
Man, thank you for the question. And no, you're not dumb and you're not scared. I mean, yeah, you're probably scared. But no, that's a very typical. I mean, I have some clients that come to me that I had a business owner come to me and has sold a multi-million-dollar business, and he wanted all principal guaranteed investments. And we did that for him. Right? So yes, absolutely, we can do that. We can put you in investments that have principal guarantees or lifetime income benefits. And so, there's just different, we may or may not end up that way, but we would start there.
Yeah.
And then we'd build upon the foundation of the principal guarantees first. And so that's how I would approach that. But absolutely, there's ways to do that.
And this kind of reminds me of, and we've talked about this in past shows, sort of the emotion versus the logic, okay. Right? And I always say that at the end of the day, sleeping well is a good thing.
Yes.
Right? If you're worried about stuff like that, certainly the emotional piece has to be satisfied. My last question is from Martha in San Diego, and she writes, David, over the years, we see that our accounts go up and down, and our broker just says, don't worry, everything will be okay. But we don't feel like everything will be okay. This reminds us of 2000 and 2008, plus we're retired. After the 2000 crash, we didn't recover till 2008. And then it took us until 2016 until we were back to even. We don't have pensions. We need our assets to last. What can we do?
Well, thanks for the question. Yeah, that's really common. I mean, the difference is I would imagine back during 2000 and 2008, you were able to withstand that because you weren't retired yet. The difference is if you experience that today and you're now losing 20, 30, 40, 50%, that's how you run out of money. Right? During 2008 was the worst time when clients came to me, not my clients, new clients, crying on my table because they had to go back to work or they lost their house, half their 401k. So the reality is we don't even need to be in that side of the equation. There's ways that we can do planning to where we can reduce risk, increase cash flow, and make sure we don't run out of money in retirement.
David, thanks so much. Really important points today. And if you want information about any of them, pick up the phone, give us a call right now, or go to our website. Don't go anywhere. We'll be right back.
You're watching The Retirement Architect with David Reyes, San Diego's retirement television.
Are you unleashing the possibilities of your assets in retirement? Hi, I'm David Reyes with Reyes Financial Architecture. As a retirement and investment advisory firm here in San Diego, we've helped countless retirees and pre-retirees create a cohesive plan to maximize their assets and, most importantly, their cash flow in retirement. Call 866-REYES-PLAN right now to schedule a complimentary second opinion review. And remember, you retire once, we retire every day.
You're watching The Retirement Architect with David Reyes, San Diego's retirement television.
San Diego, welcome back to AM 600. I'm here with the retirement architect, David Reyes. He's a best-selling author, TV personality, radio personality. Goodness, David, you're all over the place. Hey, we've got a great topic today, and that's know the risk you currently have in your portfolio. I know you're big on mitigating risk. That's an important part of a successful retirement, and whether you're a pre-retiree or retiree, you must get that checked out, right? Because once you get the last check you're ever going to get in your life, there isn't time to make up those losses. So the first piece I have here in knowing the risk in your portfolio is a stress test. So if you take a minute, I know what a stress test is when I go in to see the doctor,
Sure.
Right? Is it the same thing for my portfolio?
Pretty much,
Yeah.
right? Are you having a heart attack or not, right? We
Right,
don't want to have a heart
right.
attack in our portfolio. So yeah, it's the same concept is we're stress testing. That's why that word's used. And what does that actually mean? We're stress testing the portfolio against market events, bad market events like 2000, 2008, COVID. So it's really nice our staff inputs, the client's portfolios, all their holdings. It goes in there, a nice program, and it'll show how the portfolio actually done, both on upside and downside. So we're always trying to mitigate downside. We want to see how it's doing in the up markets and down markets. I would say you can only judge an advisor by how well he does when markets are crashing, right? That's when you judge your advisor, in my humble opinion.
Well, that makes a lot of sense because it's easy if everything's just going up, just pick a high,
Exactly.
I'm exaggerating, of course, David. But when the opposite is happening and you have a low interest rate environment, this is where you truly need an expert in retirement planning.
Yeah, it's just because on top of the fact that when you have market volatility and we're dealing with stress testing, part of what I also stress test is I look at the cash flow. So part of that stress testing software we use will analyze what the income's being generated from a portfolio because I'm stress testing that against their ability to retire as far as the income goes. I was telling in an earlier show about how the average, the 60-40 portfolio has about a 1.6, 1.7% yield. right? The average retiree needs 4 to 6% cash flow from their portfolio on average. Call it 5%. So you're going to guarantee to potentially run out of money if you have a 2%, less than 2% distribution rate on your portfolio. Inflation's running 8%. You do the math.
Goodness,
it's not real difficult to figure out.
That's a fast drawdown. Absolutely.
It's a problem.
Hey, my point number 2 here is you got to know what you own, right?
Yeah.
And you've talked about this on several shows that there's sometimes that crossover. You've got this mutual fund that's got the same things as this mutual fund, and I love the term you use for it. It's not diversification, it's diversification.
Exactly. So yeah, that's part of it too. We'll look at, if somebody has mutual funds, we'll look at the crossover and the holdings. I mean, that's getting really granular, right? Really what we're looking at, we'll do that for some clients, but I think once we go through the process, they understand that mutual funds are expensive, right? There's not reducing risk by owning mutual funds in most cases. They're just a poor tax vehicle if it's in a taxable account. We talked about liquidity on a prior show, that if, let's say, the market's crashing like it happened specifically during COVID and the market's down, dropping, and you want to get out, you can't sell a mutual fund till the end of the day. Right now, again, that's not the highest reason why I would not own mutual funds, but the fact is that's part of our process when we do the risk assessment, the fee assessment, looking at all those types of things.
Is it fair to say that know what you own, also know what asset classes you're in?
Yeah.
I mean, we've talked about it so many times, David, the typical, here's the stocks, here's the bonds. Where's the rest of it? There's so many other things that you can do that are smart if put together properly by the right advisor.
Well, think about commodities. I mean, we've owned a lot of commodities. Oil. I mean, it's kind of like when you have inflation, own inflation. What's inflation? We've owned oil. We've owned energy stocks. We've owned commodities, agriculture. Right. If you looked at our portfolios right now, you go, what the heck's all that? Right. It's the most eclectic portfolios that we've run in a long time because that's where return is. And if you have inflation, I want to own inflationary stuff. What you don't want to own is the bonds, because they get hammered during inflation.
It's so smart, that active portfolio management. This is not put it in a drawer and take it out in 10 years. Every day being managed in a smart way. I love that. We're buying inflation.
Yes.
Because certainly there are things in there that are moving upward, trending upward. And why wouldn't you capitalize on that? Why just say, just buy and hold it? No. There's things to capitalize today, tomorrow, next week, the week after. We're not going to analyze this once a year or once a quarter even. This is daily management, correct?
Correct. Yeah, exactly. Whether we're making adjustments daily, the portfolio is being watched daily, but they are in our tactical strategy that we'll make moves in those strategies when it's appropriate, right? So we're proactive. It's all about protecting capital in that portfolio. We're going to own equities. We're going to own, again, it's very eclectic right now. Commodities, gold, we own some stocks, but those are things, because those are become hedges in the portfolio. Owning energy.
I love your goal. The goal is simply, we're going to maximize your income and you're not going to run out of money, right?
That's the key.
So my bottom bullet here is, do not run out of money /income.
Yeah. That's the whole thing. I mean, again, I don't do this for brain damage, right? Because we built the firm for the clients.
Yeah.
I mean, I started in the annuity side of the business 27 years ago. Now annuities are a small piece of our practice that we do use them, but they're not, they used to be 100% of what we did. The fact is that I don't care, whatever it takes to protect clients' portfolios and create cash flow, we do. So, we went from using annuities, and we have dividend stocks, real estate. Now we have attorneys, CPAs. And so it's just because that's what clients need. We help clients that have to sell the real estate they want to sell, help them to mitigate taxes. So we do 1031 exchanges, things that get a little, that you wouldn't think that 20 years ago we'd be doing, but really we just build the firm based on what the client needs. And so if we can handle that and we can incorporate that into our offering to our clients, then we'll do that.
Hey, if you want David to take a peek at your portfolio with a complimentary second opinion, it is so easy. Just pick up the phone right now, 866-REYES-PLAN. That's 866-REYES-PLAN. Or check them out on the web at reyesplan.com. Hey, San Diego, don't go anywhere. You're listening to AM 600. We will be right back.
You're watching The Retirement Architect with David Reyes, San Diego's retirement television.
How confident are you in your current financial plan? Do you know with certainty how the recent market volatility will affect your future hopes and dreams? How much are you paying in taxes? And how much are you losing to unnecessary high fees? You didn't work to save this money so that you could spend your time worried in retirement. Now is the time to take charge of your finances so you can feel confident about your future. Call in during the next 30 minutes of today's show only to set up an absolutely complimentary, no obligation, full-blown financial review that will result in your own customized written plan. Let's design a roadmap to create a financial plan you can follow with confidence. Get the piece that so many people are missing from their retirement. Find out how having a written plan can make a difference to your retirement dreams. Call now to schedule your complimentary, no-obligation, full-blown financial review today.
You're watching The Retirement Architect with David Reyes, San Diego's Retirement Television.
Hi, and welcome to this week's Retirement True or False. David, I have some great questions this week for San Diego, and my first one is, if interest rates rise, then bonds could be the next big bubble where investors get hurt? True or false? That is true, isn't it?
Unfortunately, it's happening right now as we speak. We've had probably the worst returns for bonds in probably 40 years, since I think 1973. You've had treasuries, long-term treasuries down over 19% this year at some point in time. So, it's really difficult. I read an article about the pension funds are trying to get more into hedge funds and private equity and increase risk because their target is 7%. So think about that. When you have, stock market's been down as much as 10, 20%, depending where you're at. You've had bonds down 20%. If you're a pension fund and your target's 7, you got issues.
Yeah, and let me go one step further because I think I won't call it a basic explanation, David, but that inverse proportion of interest rates against bond rates, there's a direct correlation when interest rates go up but bonds go down, correct?
It's math. I mean, you think about it. So let's say you have a bond, it's 1%, right? And you have a bond fund, which we talk about, and rates go to 2%, right? On a 10-year bond, that's a loss of 10%. So 1% rise in interest rates on a 10-year bond, you lose 10% of your portfolio value.
So let me talk about this because clearly we have a lot of viewers right now who have bonds or bond funds in their portfolio. And I'll go one step further. I think there's a lot of people out there who don't understand the difference between the two. We don't need to get into that today. But if someone has bonds as part of their portfolio, what do you recommend?
I think bonds have a place. They can have a place, but I think they're overutilized, especially in retirement because, retirement's about income. And if you have a bond, I don't care if it's paying 3%, it's not enough income, right? And especially if they're not doing a good job of mitigating risk, which, back in the 60s and 70s, bonds and stocks went up and down together. So this is a new paradigm that people haven't experienced before. So it's unusual, but it's happened before. And so when you have interest rates rise and you have inflation, bonds are a poor mitigator of risk. And so that's a problem. So you have to look at other ways to mitigate risk.
Yeah, because most people are using their bonds as that conservative piece of their portfolio, right? Yep. And that's not necessarily a great option at this time. All the more reason to give David Reyes a call.
Right, thank you.
Next question. Most investors have read the prospectus that comes with their mutual funds. True or false?
False.
You mean everyone doesn't read that 300-page book from cover to cover?
Yeah, thank God we don't really use mutual funds, so I don't have to read too many of those. But yeah, I do read them when I need to. But again, as a firm, kind of as a rule, we rarely, if ever, use mutual funds for many, many reasons. They tend to have higher cost. They're not very efficient asset tax-wise, liquidity issues. So the reality is that no, most advisors, well, I don't know about advisors, but most clients, they never read a prospectus. No question.
And here's my question, David. Could there possibly be that much information necessary for a singular instrument, a singular product? Hundreds of pages of legalese and graph charts and everything else. If I may be a cynic for a moment, it seems like it's designed to be confusing, right? It's not designed to provide an answer or a solution to a question that you might have, unless you're one of those people that wants to dig deep with a magnifying glass and take out the highlighter and dog-ear stuff. Otherwise, I always make the joke, David, that I keep one on my nightstand next to my bed, and if I have a little bout of insomnia, boom, by page 6, I'm out.
90% of prospectus is all CYA. It's all disclosure. It's all legalese. It's all to cover, for the mutual fund company. That's 90% of what prospectus is. Last
question, David. Mutual funds are we're right in right now. Mutual funds are a smart investment tool for retirees. True or false?
I'm going to say false, true. It's not. It's a tool, right? But the fact is you got to think what is a mutual fund anyway? It's a compilation of stocks and/or bonds. So do we want to hold our investments in a mutual fund, or is there other better assets or other placeholders, so to speak? They have a placeholder to hold those stocks and/or bonds. That's the question.
Yeah, I mean, clearly for 401k, not a lot of options. Mutual fund is the choice. But if you don't have to do a 401k, would you say it's a fair statement that maybe owning individual stocks or ETFs, or
Absolutely.
if you want to be in the market, there's other ways to participate where you don't necessarily need a mutual fund. Fair statement?
To diversify, if you have 20 to 30 stocks, you can basically replicate the S&P 500. So think about that for a minute. So you can cherry pick maybe, the 50, I would say that the top 10% of the stocks, in the market represent about 90% of the returns. So think about that for a minute, right? The Apples, the Amazons, Microsoft, Googles, those type of companies. So you really could build about a 30 stock portfolio, which we do, especially on the dividend side, that can give you the same, risk profile and maybe higher returns and more cash flow. So again, you look at what is a mutual fund. If it's a stock mutual fund, it owns stocks. So we could be, a little more, have a little more precision and maybe own individual stocks and have no fees to own the stocks, right? So we could have a zero cost because there's no transaction fees with our firm in particular with buying and selling stocks.
I want to just take this last piece. I got just sub 1 minute less, David, less than 1 minute. The fees associated with mutual funds can be, not always, but can be a little bit high, right?
Yeah, absolutely. I mean, the average mutual fund is going to be between 1% to 2% in total cost, both direct and indirect cost. Direct cost, or what's called the expense ratio, which is what they charge, which is where they make their money. But you also have transaction costs, buying and selling. You have taxes. So a mutual fund, unfortunately, has to distribute all the gains every year. So they're very tax inefficient. Plus, you have what's called cash drag, which is kind of a wonky term. But basically, because of redemptions, right? Somebody wants to redeem, they have to have cash. So let's say you want to own an S&P 500 index fund. It's not going to track the S&P 100% because it's going to have cash and transaction costs and fees. So you have to really look at what you're doing.
David, thanks so much. Hey, if you want more information about anything we spoke about here today, or you'd like to set up a complimentary second opinion, give us a call right now at 866-REYES-PLAN or visit us on our website at reyesplan.com. And don't go anywhere. We'll be right back.
You're watching The Retirement Architect with David Reyes, San Diego's retirement television.
Now more than ever, it's vitally important to review your current retirement plan and get an educated second opinion. Hi, I'm David Reyes, and for many retirees and pre-retirees, this is a very confusing time. As a family-owned business right here in San Diego, we have educated hundreds of families on how to retire with confidence in all market conditions. So let us help you. Give us a call at 866-REYES-PLAN for a complimentary second opinion. And remember, you retire once, we retire every day.
You're watching The Retirement Architect with David Reyes, San Diego's retirement television.
Today I want to talk about, should you just look at your portfolio, review your portfolio just as assets, as a portfolio, right? Most of you have stocks, bonds, mutual funds, precious metals, kind of call that pretty pie chart of investments. Maybe you have some cash, some CDs. But the reality is maybe we should treat it more like a family business, which is the way that we look at investments. We want to keep the integrity of that asset. We want it to produce income. I always like to use real estate as an example. I want to keep the real estate. I don't want to sell the third bedroom of the house for income. I want the cash flow to be the cash flow so I can keep my asset. So maybe I want to pass it on to my heirs and beneficiaries when I pass on. I want it to be safe and secure. Most of you have portfolios that they have two asset classes in them, stocks and bonds mostly. Very few people even own gold as an asset class, which I like, actually. But the fact is, stocks and bonds can be very volatile. Right now, the bond market is the most volatile it's been since the 70s and 80s, right? It's historic volatility. The bond market's actually more volatile right now than the stock market. Right? I've never seen that in my career, which is 27 years. So the reality is we want to have a safe and secure retirement, right? And part of that is producing income streams that are stable, right? Through the use of maybe dividend-paying stocks. Real estate, maybe some lifetime income guaranteed products that we can use, right? We also want it to grow in value as well, right? But part of the way we grow the value is not spending down the capital, right? Keeping us enough capital so we can take the income sources away and keep as much of the capital so it can grow and pass on to the beneficiaries. So when we do that, not only do we have to do more comprehensive planning, because we've got to do retirement income planning, Social Security planning, pension planning, tax planning, estate planning. And fortunately, in our office, we do all of those things, right? And so we want to make sure, is there things that we can do not only to reduce the taxes today for our income, but also if we have a large enough estate, what are some ways that we can reduce taxes when we both pass? Or we work with a lot of business owners. What if we want to sell a business, right? We have a client selling a business right now, several $1 million business, right? We're showing him ways to reduce taxes and or eliminate tax on the sale of that business through advanced planning. So a lot of clients, not only do we have our family business, but we may have our own business inside of that. So these are kind of the areas that what I like to look at. I want to produce cash flow from the estate, not spend down assets. I want to grow the assets. I want to have a safe and secure investment strategy, and I want to be able to pass on as much as possible without taking away from our own lifestyle and retirement to my children. So bottom line, most of you have a pretty straightforward way that your advisor or you look at your portfolio. It's going to be the stocks, the bonds, the mutual funds, the cash, right? Again, we want to look at things differently here at our firm. We want to look at more like a family business. How do I maximize cash flow without sacrificing the value of the business, of the family business, which is your retirement, your house, those types of things? How do we create sustainable cash flow? How do we have reasonable growth? How do we have safety in our investments? And how do we pass on that money to our children? A much different scenario, much more deeper process than most people have. So if you want to have access to something like this, just give us a call for a complimentary second opinion, and we'll do this for you at no charge. Again, reach out to us either by phone or on our website.
You're watching The Retirement Architect with David Reyes, San Diego's Retirement Television.
How confident are you in your current financial plan? Do you know with certainty how the recent market volatility will affect your future hopes and dreams? How much are you paying in taxes? And how much are you losing to unnecessary high fees? You didn't work to save this money so that you could spend your time worried in retirement. Now is the time to take charge of your finances so you can feel confident about your future. Call in during the next 30 minutes of today's show only to set up an absolutely complimentary, no obligation, full-blown financial review that will result in your own customized written plan. This is a $999 value that we're giving away complimentary to the first 10 people who respond. We'll start with a full-blown analysis of what you already have by running a report to untangle how much you are currently paying in fees, how you're allocated for risk, and what it's costing to work with your current advisor. Next, we'll identify your goals. Where do you see yourself in the next 5 years? Where do you want to go, and who do you hope to go there with? Is your current financial plan set up to get you there without mishap? Let's design a roadmap to create a financial plan you can follow with confidence. Get the piece that so many people are missing from their retirement. Find out how having a written plan can make a difference to your retirement dreams. Call now to schedule your complimentary, no obligation, full-blown financial review today.
You're watching The Retirement Architect with David Reyes, San Diego's Retirement Television.
Thanks so much for watching this week's show.
And if you want more information about anything we spoke about here today, give us a call in the office or go to our website.
And remember, you retire once, we retire every day.